The expected has happened. As CNBC-TV18 reported, the Reserve Bank has released just a brief statement confirming that the unscheduled MPC meeting was held solely to discuss the fact that inflation was not within 6% for 9 months in a row, and what would the report be that they would write to the government. Well, to be fair, while we broke the story a week ago, the RBI governor did confirm it at the press conference earlier this week. Let's hear him out.
Today, we are in a situation where, the inflation has remained above 6% for 3 consecutive quarters. And under the accountability norms which are provided in the Reserve Bank of India Act, we are expected to send a report to the government. I don't have the privilege, authority, or the luxury to release it to the media before even the addressee gets it. That is not to assume that the contents of this letter and the report are going to be perennially, under wraps. They will be available in the public domain at some point.
Okay, so that's where we start the discussion today. We are going to get the contents at some point in time, but we do know that the report written by the RBI to the government will have the following 3 points. 1, it will cover why RBI failed to keep inflation within 6% for 9 months in a row. That's a long time. 2, what remedies is it taking? And 3, by when will it bring inflation to target given the remedial measures it's taking? Okay. Now, today I have with me 3 experts to discuss what may have been RBI's answers in that report and how are these likely to have been impacted by what happened just recently, the FOMC turning more hawkish than expected. And of course, the impact of all this on the future course of monetary policy. I have with me Samiran Chakraborty, Chief Economist for CITI India, Soumya Kanti Gosh Group, Chief Economic Advisor at the State Bank of India, and B Prasanna, Head Global Markets Group at ICICI Bank. Gentlemen, thank you very much indeed for joining us. Well, I thought the November 3 date selection was purely coincidental. Samiran, do you think that it is deliberate? The report that RBI has written or will write would have been influenced by what the FOMC decided?
Thanks, Lata. Well, if you see how the governor has characterized the global situation in the September 30th policy, it quite clearly came out that he mentioned this rapid interest rate hikes and strong forward guidance of global developed country central banks as the third storm. So to make the letter stay fresh for a slightly longer period, RBI probably wanted to draft the letter after seeing what the Fed guidance would have been. And in turn, it has turned out to be quite justified because compared to what the market perception of the terminal rate pre-FOMC was, the post-FOMC that has shifted up by 50-75 basis points. So in some sense, then whatever global backdrop this letter is likely to provide, that global backdrop will be more current now based on FOMC's assessment.
Now let's come to the contents. Section 45ZN will run for you as we speak. The first thing is, why did RBI and the MPC fail to keep inflation below 6% for 9 months? Soumya Kanti Gosh, do you think this will be the boring part of the letter? It's guessable, or do you think even in this, when the letter is released, you will look for some important revelations?
Yeah, thank you, Lata. I think the governor has also emphasized repeatedly, I think in the last policy also in the press conference, that this is because of external developments. One of them was the pandemic, the second one is the Ukraine war, and the third one is the unprecedented tightening by the central banks, including the Fed. So I think given this context, I think the Reserve Bank is likely to list these unprecedented developments on which they actually have no control. Because if you look into the reports carefully about the exchange rate movements in terms of dollar appreciation versus rupee depreciation, I think these are mostly external developments where the central bank has no such control. So my sense is that it will list out the measures where it will clearly say that these are the factors which are not controllable from a central bank perspective. So that would be the bottom line of the report, if I guess so rightly.
But what do you think, Prasanna? Do you think that, Dr. Verma had been giving the impression that the Reserve Bank should have tightened or become a little more hawkish in prior, now of course he's dovish. Do you think something in terms of demand, aggregate demand, may also find its way into the report, probably on Dr. Verma's insistence?
I think very clearly Governor, I would call it, came out with all guns blazing yesterday when he actually justified the reasons as to, I mean, not exactly the reasons, but the kind of actions that they have taken. And he actually said that there is no way to evaluate the counterfactual, which is to say what would have happened if they had, hiked a little earlier, because we were actually just coming out of COVID crisis, which is not just a financial crisis. I mean, it's obviously a health and economy-related, jobs-related crisis. So I guess that I think is going to be the primary reason. And then, of course, the most important thing that the governor himself mentioned was about the Ukraine war on 24th, which led to a lot of supply side related reasons. So I think these are the two things which I feel.
All right. So that's not going to give us. I think what remedies they will take could be a very interesting answer. Samiran, if and when that letter is released, will we get a very good idea of whether it's entirely front-loaded or whether there is a lot of work to be done? Would that be an important paragraph?
Well, the way till now the RBI has looked at things, they have quite clearly stayed away from giving too much forward guidance in a world filled with a number of uncertainties. So at this juncture, while drafting the letter, it would be very difficult for them to lay out an exact path of how the policy response function is going to be. But one can clearly say that they will articulate the fact that whatever the COVID-related easing of monetary policy has been on both rates as well as on liquidity, that has now been practically fully reversed. Now, whether they will use the Powell kind of language of saying that we need to go to restrictive territory to control this inflation, that will be something interesting from my side to see. But otherwise, it's very difficult for them to give a precise quantitative target of how much more rate hikes or more liquidity absorption is going to be required to bring down inflation. For me, the more important part is going to be that are they going to just focus on inflation coming below 6%, or is there going to be a more active guidance towards taking inflation down all the way to 4%?
Soumya, don't you think the RBI is almost tasked with saying when it will come to 4 and not when it will come to 6? Target is 4, isn't it? They have to give a time, don't they?
No, I think, Lata, it's very difficult to give a time in these uncertain circumstances. Look at all central banks around the world. Even Fed, which was actually struggling to get the inflation upwards of 2%, I think, in 2020, now it's having its hands full in terms of an 8% inflation rate. And given the fact that I think there are too many uncertainties, moving parts, global uncertainties, now there are also domestic uncertainties in terms of a very unprecedented unseasonal rains which has happened in October, and we all know how havoc it played to the inflation trajectory in 2019.
So short point, you are not expecting when the letter is publicized in the public domain, you don't expect them to say that we will bring it down to 4 in whatever 2024 or something like that? You don't expect them to say that?
I don't expect that amount. It can only say that we will strive to attain it and get it down in the inflation band, but not to the central midpoint of 4%, to be exactly specified.
Prasanna, would you say that after the FOMC's, or rather Jerome Powell's statements that the terminal rate is likely to be even higher than what they thought, and now the market itself has moved higher in terms of its expectations, do you think the Reserve Bank, your expectations of hikes from the Reserve Bank have gone up? what are you expecting in December and later, a peak rate?
So I think, Lata, very clearly we have moved from higher, faster, longer to even higher, slower and longer. I mean, that's the way I would describe the Fed reaction. So basically, we are looking at 5 quarter and base of 5 to 5 quarter, or maybe even 5 half. We don't know, and we are looking at these hikes to come over a little more slowly than the kind of urgent rate hikes that they were doing earlier. Now, what this has opened up actually is that I think while the governor's press conference yesterday was quite soothing and calming kind of a statement, I think there is no other option but for the Reserve Bank to kind of go with the Fed in terms of the direction. I'm not saying they need to do a one-on-one increase in the policy rate. So even if you assume a 125 basis point rate hike by the Fed from the current levels, which means we are talking about something like 5 to 5 quarter, even a 75 basis point rate hike from the RBI seems to be par for the course, because you can't let the interest rate differential to fall to too low levels. It's already on the lower side. So I would say that, yes, after yesterday, my inclination is to believe that the likely repo rate, terminal rate, or where they were likely to pause for some time has probably moved higher by 25 basis points from 6.5 to something like 6.75. And I'm inclined to believe that the next policy they will possibly would like to do 50.
Samiran, the CITI economist, I think, has the global economist has, I think, upped their peak rate by 75 basis points. Any change in your peak rate expectations for India?
I think, Lata, where the markets are slightly confused is that the MPC minutes of the September meeting was somewhat more divided, where the couple of external members, they clearly articulated that the MPC mandate is only to look at the growth inflation balance and not so much on the external sector, current account or the currency, for which RBI has other tools. So if you take that sort of a view, then it's difficult to justify why RBI will have to hike more than what we were expecting before. Whereas the other part of the committee tends to think that there is an indirect loop through the currency, which the exchange rate passed through onto inflation could make matters worse. And that's why there is need to do some kind of a preemptive hike in line with Fed. Whichever of these two arguments win will determine whether the terminal rate in Indian context would be higher or not. At this moment, we are still working with a 6.5% terminal rate, but we do acknowledge that the interest rate differential between Fed and RBI would become pretty narrow if RBI has to stop at 6.5. It would be a challenging task.
Okay. Well, the other impact, of course, will be on the currency. Take a quick break and we'll come back with questions on what may be the impact on the rupee, with the Fed turning more cautious, more hawkish than the markets were prepared for.